Some people say the average stock market return is between 7 to 10%. Other people, including like Dave Ramsey, say the stock market returns 12%. So what is it? The only way we can figure out is to actually calculate it. Easy. Hey guys, how's it going, and thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money. Please do not forget to subscribe. So in this video, we're calculating the average stock market return. It's very simple. It is not higher than 5th grade math. There's no Pythagorean theorems. There's no calculus involved. It's simple. Because if you are like me, I don't really like to trust other people. A lot of people say whatever numbers, I want to calculate it so I could actually see it. But this is the average stock market return. It is not the actual stock market return. There is a difference, and we'll be seeing why. This will, it might not a little bit, it will surprise you. So I did this all on Excel. I mean, technically numbers because it's Mac, but I got all the numbers from online. We calculated everything, and I'll show you exactly how we come about that. So I'm going to build you up to exactly how we're going to calculate this. So let's get into it. So this first is something that's very, very interesting. And this is going to determine the difference between actual versus average. So real quick, you can see everything right here if you want to look ahead, but I'm going to explain everything. First, let's look at this little chart that I created for you guys. This shows, like, let's say the first year you get a 50% return. Then the second year you get a negative 50% return. So then it goes like that for a couple more cycles. So positive 50, negative 50, positive 50, negative 50. So the average return is technically 0%. However, that is not what actually happens. So going back to the top, I have the year like we had right here, and this is the returns. However, this is the balances that we have. And we do these calculations manually. And this is what ends up happening. Now this is completely different than an average of 0%. So we could see we start with 10,000. 50% return gives us 15,000. But then a 50% drop then gives us 7,500. And then so on and so forth. So after 6 years, and it's still an average return of 0%. However, you're ending with $4,200. That's the actual return is negative 57%. So that shows you that the actual and the average is different. So let's keep that in our minds when we're calculating the next step. So let's continue with the S&P 500 average. Next part is looking at the S&P 500. Again, you could probably look ahead, look at some numbers, but let's explain what's going on. So first, you could see the year that we're looking at, column F. It goes back to 1926, and that is a total of 92 years. And column C gives you the actual return for each year. All right, so this goes all the way to 2018. I didn't include 2019 just because it didn't conclude yet. Simple, you know, with not even passing 5th grade math. To figure out the average, you're going to total all of these returns up and then divide by the total, which is 92, and that gives us the average return of 11.88%. Now, real quick, if you want, so that would be the average return that people are talking about. So it's actually pretty close to what Dave Ramsey is talking about. Something else you might want to consider is in the 1980s is when the 401k was created and becoming popular. So that's when it was more readily available for the individual to start investing. So if you want to take the average return starting around that, it was actually above a 12%. Just, I guess, a fun fact for you. So above a 10% return is actually the average of what the S&P 500 is giving. Now, this is where it gets a little bit different. So let's talk about compound interest. If you're watching this video, you probably heard of compound interest before, how it's so simple to become a millionaire. Everyone goes over compound interest, and anyone could do this. However, I did this as well. A lot of other YouTubers do it. However, it's not so simple. We're going to take that average return of 11.88% and plug it into a compound interest calculator to see what we get. We're starting with $10,000 over 92 years with that 11.88%. And after that, we will get, after 92 years, of over $300 million. That's pretty attractive, right? $300 million. I mean, you have to wait 92 years for that. A lot of us might not survive that, but with technology and medication, maybe. But let's continue on. What we have now, you could see the $300 million is what we've recorded right here with the 11.88%. Now, doing the actual calculations, going back to the very bottom, we're going to do the actual calculations. So for example, we start with $10,000, and in 1926, the return was 11.62, which will then get us $11,162, and then continuing on with that. So if we continue and do that over 92 years, it does not give us that $300 million. It in fact gives us $73 million. Now I'm trying to keep this slow just to explain it so everyone understands. So if you do a compound interest calculator like anyone could basically do, you're getting 300 million. Fantastic number. But if you do it manually, you're getting just over 70 million. I mean, I'll still take the 70 million. However, that is around a quarter of what the compound interest calculator is getting. So it's actually not that 11.88%. It's more like just over a 10% return. I'm calculating around a 10.16%. Now it might be only like a 1.5% difference, but you could see that drastic change from 300 million to 70 million. So if this isn't hitting you yet, let's do a little bit more realistic numbers that anyone could achieve and anyone could calculate. So let's look at what that looks like. So again, let me give you the layout. If you want to look ahead, whatever. But column A shows you the year, and column B shows you the amount. So again, we are starting off with $10,000. We're not looking over here at columns E and F yet, okay? We're looking at just this. And this is, like we saw before, the average return. I'm just going to round it to 10%. So if you got an average of 10% over, what was it? It was like 49 years or so. Yeah, after 49 years, you hit the $1 million mark. So it's going to be between year 48 and 49 that you hit $1 million with an average return of 10%. However, you guys probably saw over here, but what I did here, these are not actual numbers. I just threw some numbers in there that could be similar to the stock market. Again, we're still starting with 10,000, but I varied the amounts. So for example, this is 10%, negative 15%, and it's just erratic, just like the stock market is. So if we do this calculation, it's very interesting and kind of messed up at the same time. So after the same 49-year period, the average is still 10%. You could add all these numbers up and divide the amount of years, and it still gives you a 10% return. But you actually end up not with $1 million. You end up with $500,000, almost half. If this doesn't make your jaw drop, I'm not sure what will. Because everyone is talking about, oh, average stock market return, 10%, simple. After 50 years, you're going to have $1 million. Well, this is what this calculation doesn't show us. Because the stock market is very erratic. That, going back to Warren Buffett's rule, don't lose money. because losing money sucks, and this is exactly why. A compound interest calculator only calculates if the rate of return is fixed at a 10%. The stock market is never fixed. It varies all over the place. And you could see how drastic of a difference that becomes. And let me show you something else that's even more interesting. All right, so one more trick that nobody showed you, I want to show right here. So let's just be a little over dramatic here. We're still going to keep that average 10%, but let's say you're getting close to retirement, but let's say you had a negative 50% drop, and let's say around year 30, you had a 30% increase. Okay, so that average of 10% is still 10%. However, now it dropped even lower. You have $450,000. So it actually depends, on the order of the returns that you get. So to put it simply, the average stock market return is over 10%. At least with the S&P 500, history shows since 1926, it's over 11%. However, that 11% really doesn't mean too much because it really determines on the order of those percentages. So that's why you have to be super careful. It sucks to lose money. If you're going to lose money, do that early on in your life. If you're around my age, like in your 20s, that's when you could screw up a bit. But when you're going to have like a 50% drop, when you're like a couple years away from retirement, that's when actual returns happen. That's when reality punches you in the face and you're going to have less than you calculated. Now, this main idea I learned from Tony Robbins. I just finished one of his books. It's a huge book, but it's Money Master the Game. I'll leave a link in the description if you want to check it out. It goes into so much more detail with this stuff and even more investment ideas. And this completely opened my mind, and it's pretty scary. You know, if you do a compound interest calculator, you're going to simply become a multi-millionaire if you have time, right? But when reality comes into play, that's the difference between average returns and actual returns. Again, this is a reason why losing money is so important, because when you lose that 50%, you don't need 50% to get back to even. You need 100%. So if you're going to be risk averse and don't want to lose money, there are ways. Real quick thing, Ray Dalio goes over his all-weather portfolio, how your portfolio could really perform in any type of environment going on in the economy. So if you're interested in that, I'll leave a link in the description so you can check that out. I have a video going into that, his holdings, his portfolio allocations, and it's very interesting. So I tried to make that simple. Was I successful? I'm not sure. Hopefully I was. Let me know what you guys think. If you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. And if you seriously have questions about this, because it's a little bit more math intensive, but it's really important to understand, especially when we're younger. That's when we got to make the right decisions. So thank you so much for watching, guys. Hopefully that opened your mind a little bit and learned the average of the stock market. So thank you so much for watching again, and I'll see you in the next one.